Okay, for this video, I'm going to cover a fact pattern where you can have multi-member LLCs that are treated as partnerships, but there's not going to be any U.S. taxes owed on the earnings. So this is directed towards the international community. So if you're a non-resident of the U.S. and you want to create a U.S. entity for your business and you have other partners, this is going to be something that you're going to want to watch, because although you might have tax filings in the U.S., you can likely avoid having to pay any U.S. tax if everything is structured right, and your business operates for the most part exclusively outside the United States. So I've got a lot of material to cover here. We've got 8 slides, and these are the various topics that we're going to dive into. So the first one, we're going to cover some basics of LLC tax, and then we're going to get into what does an LLC partnership tax return look like when you have all U.S. Resident partners. And I want to cover that just so you can get some perspective on what the tax profile looks like, and then how it shifts when we have all non-resident owners. So we'll look at taxation of non-resident individuals and foreign corps. And then some of the meat of this is, what does it mean to be engaged in U.S. trade or business and have effectively connected income? So we'll look at some of the factors for USTOB, and then also drill down into where we conduct the analysis. So the U.S. trade or business analysis is conducted at both the entity level and we look at the activities of the partners as well. And then we'll close with some final items to consider. Okay, so let's get into the first slide with some material here. So the fact pattern that we're going to be working with throughout this video is going to be the following one here. So we're going to create an LLC, Fake Marketing Guru LLC. This is a Wyoming limited liability company formed in 2020. The LLC is going to operate as a marketing consulting agency, and it's going to be owned by 3 individual partners. So we have Mark, Adam, and Sarah. Now, all 3 of these persons are citizens and residents of Bermuda. Okay, so they're not dual U.S. citizens and Bermudian. They're all Bermuda citizens and residents. They live and work there full time. Okay, so none of them, again, are U.S. tax residents, meaning none of them are U.S. citizens. Nobody's got a green card, and nobody's in the United States long enough to meet that substantial presence test. Okay, so the LLC, again, we're going to take the position that this is a Wyoming LLC, a partnership, because it has 3 owners, but it's going to be operated exclusively from outside the U.S. So it's not going to have any U.S.-based employees or offices, no U.S.-based dependent agents or owners that are physically in the United States, right? So everybody's going to be living and working from Bermuda, and none of them are going to be traveling to the U.S. for work, right? And this is a very common fact pattern, right? Because nowadays with remote work and the internet, you can operate a business from anywhere, right? You don't, even if you have U.S. customers, you don't need to be coming to the United States to do any kind of work, right? You just pick up the phone and call them or email them. So we're going to cover all of the tax issues that impact the LLC itself and then the non-resident owners. Okay, so some of the LLC basics here. So when you have a U.S. LLC with more than 1 member, it's going to default to a partnership for federal tax purposes. Okay, and those rules are outlined in the Treasury regs here in 7701-3B. Now, an LLC, a U.S. LLC that is a partnership, is a domestic partnership for federal tax purposes because it was created and organized in the United States. And this is important because when we talk about domestic partnerships needing to file a Form 1065, the standard is if you have a domestic partnership, it's got to file a 1065 every year, right? It doesn't matter where the owners are based or where the activities of the company are based. If you have a domestic partnership, so this is a U.S. LLC that's a partnership, it's got to file a 1065 every year, even in cases where the entity might not be subject to tax or where the non-resident owners might not be subject to tax. And that's the crux of this video. We're going to cover a scenario where you have a domestic LLC that needs to file a return, but there's not going to be any taxes owed at the LLC level, nor are the non-resident partners going to owe any tax. So one of the principles of partnership taxation here in 701 is that partnerships are conduit entities, right? So they're not subject to taxes directly. Rather, the persons that are partners in the partnership are liable for income tax on their allocation of the income. Okay, now we covered domestic partnerships over here, always needing a 1065. Foreign partnerships do need to file a 1065, but only in limited circumstances, right? So if you have a foreign partnership and it has gross income from sources within the U.S., or it has gross ECI, effectively connected income with a trade or business, then it will have to file a 1065 return and likely pay some taxes because of the ECI issue. And that standard is outlined in 6031E2. Okay, so let's move on to the next slide here. Okay, so in this slide, what we want to do is I want to, for the individuals that are non-residents, I want to cover what an LLC partnership tax return and taxes would look like if you have all U.S. persons, right? Just so we can get a baseline here. So in this fact pattern, we've got a Delaware LLC, FNJ Consulting LLC, created by Frank and James. They're two equal partners. They've each got 50% of the equity, and they're both U.S. citizens living and working in Atlanta. So the LLC is an accounting firm that has an office there. They're two owners. They live and work in Atlanta. All of their business is there, right? So what does that look like when they go to prepare their tax return? Well, the LLC is treated as a partnership for federal tax purposes. So they formed a LLC partnership. It was a partnership by default. They haven't made an election to be an S corp, nothing like that. So what the LLC does is it prepares a 1065 every year, and a Schedule K-1 is provided to each partner, and the K-1 shows their allocable share of the income and expense. Okay, so this is most commonly what we see in the United States when we go to prepare 1065s, because we have U.S. businesses with U.S. owners. So again, just to re-highlight here, under 701, the partnership is a domestic partnership. It needs to file a 1065, but partnerships are not subject to tax directly, right? The owners are ultimately the ones responsible for reporting their income and paying tax. Okay, so the federal tax rules, and just to illustrate this point, they respect the conduit treatment even in cases where you have partners subject to a wide variety of effective tax rates. So if we look at the example above, let's say the LLC generated $200,000 in net profits. So $100K is being allocated to each partner, Frank and James. So Frank and James have a K-1 showing $100,000 of income allocated to each partner. And they report this 100K on their 1040 tax return. Now, Frank, one of the partners, he's a wealthy investor in some other ventures. And so he has another 400K of additional income from other investments, right? So if you're looking at Frank's tax return, he's got all this other income coming through other businesses other than this consulting accounting firm. So his total income for the year is, let's say, $500,000, which bumps him up into a very high effective tax rate. So his effective tax rate was 39%, and that's because he makes a lot of money. Now, if you look at James, you know, his only source of income, let's say, was the 100K from the business, right? So he's got a K-1 that shows the same 100 grand, but because he doesn't make as much money as Frank from his other income sources, his effective rate is much lower. So it's going to be 18%, let's say. So Frank's taxes on the 100,000 is going to be 39,000 effectively, because he's in a 39% effective rate bucket. And then James, on his share of the F&J consulting income, is only 18 grand, right? Because he's in a much lower bracket. So, you know, this is important because, again, we have to keep respecting the conduit treatment of the partnership, right? The partnership, it's the same business, but when you're reporting income on the personal tax returns for the individual owners, you could have very different effective tax rates on arguably the same income, right? And so that's the principle of this partnership tax issue. So now in this example, all the operations are conducted from within the U.S., you know, U.S.-based office, U.S.-based employees, the two owners in the U.S. So the entity and the business itself is certainly engaged in trade or business within the U.S., and it has U.S. source ECI. So what we're going to look at with the non-resident example is we're going to have a scenario where we have no U.S.-based ops, and so we don't have a U.S. trader business nor any U.S. source ECI. Okay, let's move on to the next slide. Okay, so now let's get into some of the tax issues for non-residents. So we're going to go back to our example fact pattern that we started with on the first slide. We've got our fake Guru LLC here, Wyoming entity, owned by Mark, Adam, and Sarah, all residents of Bermuda. So they're doing everything from Bermuda. So the first question posed is, how are non-resident aliens, individuals, NRAs, taxed in the United States, right? So the base rule is they don't pay any tax, right? So if you're a non-resident of the U.S., you're generally not subject to any U.S. taxes unless you derive income from U.S. sources, right? And that makes sense, right? If you don't have any nexus to the U.S. and you're just living in Bermuda and working there, why would you be exposed to the U.S. tax system? You shouldn't, right? Unless you have investments in the U.S. or you travel to the U.S. or you're engaged in some kind of business in the U.S., that's where you might create some exposure. So non-residents are subject to tax in principally two ways. So if we look at Code Section 871, the first one is U.S. source income that's not connected with the trade or business. So this is outlined in 871A1. And this is frequently referred to as FDAP income. So FDAP income is fixed, determinable, annual, or periodical income. It's generally the types of passive portfolio income. So if you're investing in U.S. source interest, dividends, rents, royalties, annuities, there's a whole list of other items. Those amounts are subject to tax in the U.S. At source. So for example, if you're a Bermudian and you open a brokerage account in the U.S. and you invest in U.S. stocks that pay a dividend, the U.S. dividend payment to you is U.S. source dividend income, and it's generally subject to a withholding tax of 30%. Okay, so that's the first layer of tax that could be imposed on a non-resident. If they're investing in certain types of U.S. source FDAP income, there might be some withholding tax at source. So that's number one. The second way a non-resident can be subject to tax is under 871B1, which is if you derive income connected with a U.S. trade or business. Okay, so if an individual is engaged in a U.S. trade or business and has effectively connected income, ECI, with that U.S. trade or business, the non-resident is going to be subject to income taxes at graduated rates, meaning you're subject to the marginal federal tax rates in the United States. So your tax profile is very similar to if you were a U.S. resident, right? So marginal tax rates, if we jump back to the example here with Frank and James, this is what we're talking about, the effective tax rates as part of the marginal rate system. So if you are non-resident and you're invested in a U.S. business, you would report that net income, and your tax rate would, the effective tax rate would change based on how much income you made, right? That's principally what's happening here. So let's look at how this impacts the partnership tax issues. So the standard is a non-resident alien who is a partner in a partnership that is engaged in U.S. trade or business is himself considered engaged in trade or business within the United States, right? So the test of whether a partnership is engaged in trade or business is the same as in the case of a non-resident alien individual. So what they mean there is if you are a non-resident and you're engaged in trade or business, we look at that analysis, and the same analysis is done if you're doing it through a partnership entity. So when we have a U.S. partnership, we have to assess, is the partnership engaged in trade or business? If so, then the non-resident alien that's a partner is so engaged in that U.S. trade or business. Okay, so now if a non-resident alien receives an allocation of ECI from that partnership, the ECI is U.S. source income, right? It's effectively connected income with that trade or business. So the non-resident should be filing a 1040-NR, which is a non-resident individual income tax return, and they report their allocation of those earnings and they pay tax at the graduated rates. Okay. Now, in certain cases, and we won't cover this too much in this video, but when you have a domestic partnership that has ECI allocated to non-residents, the partnership is responsible for withholding some tax under 1446. So what that means is if you have a partnership that allocates, let's say, $100,000 in income to a non-resident, and it's determined that the partnership is a U.S. trader business, it has ECI, the partnership has to take tax out of that allocation and send it to the IRS. And that's done as a mechanism to make sure that non-residents are paying taxes, right? So it encourages compliance, right? So the non-resident has withholding tax on their allocation of income, and that kind of basically kind of pushes them in the direction of making sure they file a 1040-NR to actually report the appropriate amount of income and taxes. Okay, so let's move on to slide 5 here. Okay, so this is the big question. What does it mean to be engaged in U.S. trader business? And the reason why this is so important, because when you have a U.S. partnership with non-resident owners, unless the entity is engaged in U.S. trader business, there's not going to be any U.S. taxes owed on those earnings. So the partnership entity, the owners really need to assess this, these facts and circumstances for their company, because if you don't have a U.S. trader business, you still file a return, but there's no taxes owed in the U.S. If you have a USTOB, then you've got to, pay some taxes and file some additional returns. So USTOB is not specifically defined anywhere in the tax code. It's one of those things where it's kind of referenced here and there, but there's really no clear-cut rule or standard. Now, what we do have is a handful of tax court cases, right? This has been litigated in the past, not too often. A lot of these cases are 40 years old, 40 plus even. But the language used in a lot of the court cases is this standard here. The activity in the U.S. must be considerable, continuous, and regular, and the primary purpose must be for income or profit, right? So there's no one factor that kind of tips the scale. You've got to analyze all the facts and circumstances surrounding the activities of business and what are the owners doing, right? So this note here is really, really important, because this is what I see done wrong all the time. The courts will not automatically impute a USTOB and ECI if you simply have a domestic partnership, right? So if you have a US LLC that's taxed as a partnership and it has non-resident owners, just because you have a U.S. partnership does not mean you have a U.S. trader business. And so I see all too often where tax preparers will prepare a 1065 for a U.S. LLC, and then they just assume it's a U.S. trader business. And so now all of the non-resident owners are filing 1040-NRs and paying tax, and it's just completely wrong. Both domestic and foreign partnerships have to carefully analyze the activities to determine whether a USTOB, right? So again, just because you have a U.S. partnership does not mean you have a U.S. trader business, right? Just that entity's location alone is not sufficient. So where are some tax code provisions where they have some actual instances of what constitutes a USTOB? Well, it does say clearly in 864 that the performance of personal services within the United States, so that means you're physically in the U.S. when you're working, at any time during the year will be considered engaged in U.S. trader business, and it will generate that U.S. source income. Okay? Now, the physical location of the person performing the work is what's relevant here. It's not the location of the payor. So in other words, if we look at our Bermuda example, if our Bermudian partners are in Bermuda, living and working there, and the client is in the United States, the performance of personal services is in Bermuda, right? They're not flying to the U.S. to do the work. So even though the payment might be coming from a U.S. customer, it's still going to be foreign source if the individuals performing the work are in a foreign country, right? So, okay, so that covers the personal services in the U.S. The second example where we know we clearly have a U.S. trader business is the sale of real estate. So if you sell real property in the United States, the individual shall be taken into account as if the taxpayer was engaged in trader business within the U.S., and the gain on the sale of that U.S. real property is going to be ECI. So this is outlined very clearly in 897A1, and this was all added under the FIRPTA reg. So FIRPTA is Foreign Investment in Real Property Tax Act, And what that was designed to do is make sure that if you're a non-resident and you own U.S. real property and sell it, there's going to be some tax exposure, right? You can't just own U.S. real estate and try to sell it either directly or via a corp or transfer it and not have to pay any tax. So that's one instance where we clearly know that if you're a non-resident and you own U.S. real property, that's going to be USTOB and ECI issues. Okay, so most foreign-based businesses, services businesses, with a U.S. partnership will not have a USTOB, right? And this goes to the personal services sourcing issue. So if we look here at our example, let's say that the LLC is hired by a Miami-based company. They pay him a fee of $25,000 for the consulting services. So Mark, Adam, and Sarah are the three partners they're doing all the work. They're doing all the work while they're physically present in Bermuda, and they're not hiring anybody else to do it. Right? So the LLC, again, it doesn't have a U.S. office. It doesn't employ any persons in the United States. So under Section 862, the services income, the work that Mark, Adam, and Sarah are doing, is going to be foreign source income. And so because the LLC, again, doesn't have any U.S.-based offices, it's unlikely that that level of activity is going to create a USTOB or any ECI. Right? There's nothing going on in the U.S. You just have a customer there, and you just have a domestic partnership, which, again, under 701 is not subject to tax, right? You have to look at the activities of the owners and the activities of the business to determine whether or not it actually does create a USTOB and any exposure for those foreign partners. Okay, so let's move on to the next slide here. So what are the relevant factors when we look at whether we have a USTOB? Well, remember the standard here is considerable, continuous, and regular, right? Which is very vague. It is. I mean, there's really no precision here. So we have to look at all of the facts and circumstances surrounding the business and kind of weigh whether or not we actually have a USTOB. So one question asked is always, well, what portion of the revenues are U.S. customers versus foreign? So if we have, for example, a company that does $3 million in annual sales and only $100K is from customers, I think, probably certainly no USTOB here, not just based on this fact pattern alone, because you've got most of your sales are foreign and you've only got a small piece from a U.S. customer, so probably not an issue there. But what if you had $3 million in sales and all of them are from a U.S. customer? Well, maybe. I mean, that's a fact that is tipping in the direction of maybe having a USTOB, right? If a court looks at that and they say, well, again, the standard considerable, continuous, and regular, you've got a lot of sales and it's all U.S. So maybe that might be a bad fact pattern for you. So, okay, so second element is, where does the LLC open and maintain its accounts, merchant accounts, credit cards? Does it have U.S. accounts only or does it have U.S. and foreign? Now, the courts have said that having a U.S. bank account alone does not create a USTOB. But again, if you get before a judge and they're analyzing all this information, if you have a U.S. account and you also maintain foreign accounts in different currencies, and then I think that would lend to help you in arguing that, look, we don't have considerable, continuous, and regular nexus with the U.S. because we've got all these other foreign operations as well. Okay, so point 3, where does the LLC own and manage assets? This is a big one because this can really kind of tip the scales one way or another. If the LLC owns a building or office space in the U.S., that's very likely going to create a USTOB, right? Because now you've got physical situs in the United States. You don't just have a domestic partnership with, let's say, a mail forwarding address. You've got an actual building or office space. So that's probably going to be a USTOB. If the LLC doesn't have any space in the U.S., but they have space in a foreign country, then that's a better fact for you, right? Because now you've got nexus somewhere else, and you don't have physical nexus in the United States. So that's a better piece of information that would help lend towards having no U.S. trade or business. Does the LLC own inventory and store it in the U.S.? This is, again, you're creating some physical nexus here, right? So if you've got inventory that's stored in the U.S., either you store it directly or use a third-party service provider, could create a USTOB. What address do you display to customers? This is a small one, but it's still important, right? I mean, does the LLC have a U.S. virtual office or mail forwarding address? Is that what's displayed on your website? Or do you communicate to your customers and your investors and everybody else that, no, I've got a Bermuda address, we got a Bermuda office here. We don't have any real nexus in the U.S. Now, the mailing address alone isn't sufficient to create a USTOB. The courts have ruled on that too. So if you just have if you have a PO box or a mail forwarding address because you pay a third-party company to receive your mail and then forward it to you, that's okay. That's not going to be an issue. So this next one here is relevant, certainly relevant too. Where do you hire contractors to assist with the business, right? So are you hiring U.S. or foreign independent or dependent contractors? Ideally you would want to hire all people that are not in the United States because, again, if we're looking at the sourcing of the services income here, where are you doing the work? Ideally they should be independent agents outside the United States. But if you do have to hire U.S. contractors, that's okay, so long as they're really independent contractors. So this is, beyond the scope of this video, but what a lot of companies get trapped with is they hire persons that are, quote, contractors, but they're really employees, right? They work for you full time, you set their hours, they have to come to you to request for time off. So the facts start to look like these are more dependent agents. And if you've got dependent agents in the United States, that creates a problem, right? Because when you have employees, so this is the last bullet point here, U.S.-based employees that are dependent agents is going to create a USTOB. The courts are fairly clear on that. So, even if the employee is working remotely for their home. So if we go back up here, let's say the office building example. So let's say the LLC doesn't have its own office or building in the United States, but you do hire an employee and they're just working from their home office. That's going to create a U.S. trader business. That's going to create some ECI because this individual is your dependent agent, they're your employee, and they're living and working from inside the U.S. So that's going to create a problem. So that covers it for these factors. Let's move on to the next slide. Okay, so so for this slide, what we're going to get into here is, when we do this USTOB analysis, we want to look at the LLC activities, and then we also need to consider what are the partners doing. And you'll see why we have to consider what the partners are doing, and we've got a case that is on point with this issue. So first step is always review the activities of the LLC, right? So review the potential USTOB issues at the entity level. So does the LLC, does that legal entity have any U.S. offices, right? So did you buy a property? Do you lease a property in the LLC name? Did the LLC hire any independent or dependent contractors or employees that are in the U.S.? These are the pieces of information that we need to consider. Now, if it's determined that the LLC does create a USTOB, then it means that all of the non-resident partners are deemed engaged in that U.S. trader business. So they're all going to be subject to taxes on their income, even if they don't even come to the U.S. So if we look at the example here, let's say our fake marketing guru LLC opens an office in Tampa, Florida, and hires 2 people to work from within that office. Now, Mark, Adam, and Sarah, they continue to live and work from Bermuda. They never even visit the Tampa office, right? They just don't need to, but they need an office space to put their employees. Well, the activities conducted by this LLC through the office in the U.S. has created a U.S. trader business. So now all of the income that's generated within the LLC, reported on the partnership return, and allocated to the partners is going to be ECI, right? So it's ECI in connection with the U.S. trader business under 875.1. So now the partners are going to be subject to tax on those earnings. Okay, so that's why we review the activities of the LLC first. Now, the second step is always review the activities of the partners to make sure they don't create any problems for the entity. So what do I mean by that? Well, if a non-resident partner needs to travel to the U.S. to conduct business, their physical presence in the U.S. could create a USTOB for the entire company. So if we look at the example here, fake marketing company, again, owned by Mark, Adam, and Sarah. They're all in Bermuda. The LLC, in this case, doesn't have an office in the U.S., no U.S. employees, no nothing, right? So all the employees and contractors are in Bermuda, but Mark, all by himself, has to travel to the U.S. on a regular basis to meet with customers, negotiate some contracts, work on general business management tasks, and he's doing all this while he's physically in the U.S. Now, he's doing it from hotel rooms, or he's going to the offices for the customers and the clients. So there's no office in the U.S., but he's physically on the ground running around doing all this work. So even though the LLC doesn't have those U.S. offices or employees, Mark's conduct as an owner, as an agent for the business, will create a USTOB for the entire company. So now everybody's roped into this, right? The income allocated to the partners is going to be ECI because we have a USTOB. And this is the real life example here, right? This was the case with an Argentinian company. You have an Argentina-based partnership. Had a couple partners. I think two partners. One of them, Belanovsky, would have to travel to the U.S. frequently to conduct business. So, the partnership was based in Argentina. Everybody else is in Argentina. There was really no U.S. office, but because Belanovsky had to come to the U.S. frequently, the court determined that because his frequent trips to the U.S. were continuous, regular, substantial, those factors. His activities as an agent created a USTOB. So his conduct was numerous and varied. This is the language that they use, not merely routine or clerical. So because of his activities in the U.S., it created a U.S. trader business for the Argentinian partnership, right? So what that means is the Argentinian partnership had to get an EIN. It has to file a Form 1065, report the income, and the non-resident partners are now paying tax. So that's why very, very important to try to limit your activities in the U.S. as much as possible. Your physical activities. Remember, you can have clients in the U.S., but and that's fine. You just have to be doing everything outside the country. So now, after you determine you have this USTOB, what is ECI exactly? Well, once you have a USTOB, all that U.S. source income is going to be presumed to be effectively connected income. So, in this example, fake marketing company, if they have a USTOB, all the income that's flowing through it, that's U.S. source. So if Mark is in the U.S. working, the income that he's earning while physically present in the U.S. is going to be ECI. Yeah, and then even in certain circumstances where you have a business with a U.S. trader business and a U.S. office, foreign source income can be treated as ECI too. So what that would look like is if you open a U.S. office and you had an employee there that was, let's say, negotiating a contract for work that's going to be performed in Germany. If all the work is done in Germany and it's foreign source income, because it was connected with the activities completed by this U.S. trader business or this U.S. office rather, even though it's foreign source, it's going to be ECI because it was effectuated through this U.S. office location. That's basically what they're looking at. Okay, so last items to consider here. Again, the focus of this tutorial was on a U.S. LLC that conducts services-related business. So the services businesses are much easier to analyze, right? Because you don't have any physical products or physical locations in the U.S. generally. You're just living and working outside the U.S. You're doing everything remotely, and so it's not super clear, but it's pretty easy to get to a position where you can comfortably say you have no U.S. trader business, you have no ECI, so there's no tax issues. This would be a whole different analysis if you had the multi-member LLC partnership that was, let's say, selling actual product into the United States. So for our Amazon or drop shipping sellers, because selling inventory in the U.S. is generally going to be U.S. source income. It's not foreign source services income. It's going to be U.S. source. And so we have to more carefully analyze whether you still have a USTOB that could generate the ECI. Now, this rule here, the dependent agent rule, this comes up a lot more in a treaty context, but I see a lot of practitioners state that as long as your business doesn't have a dependent agent in the U.S., it's not possible to create a U.S. trader business. And that's just not true. There's no such rule that says that. If you have a dependent agent, you almost certainly have a USTOB, but it's definitely possible to have U.S. trader business without any dependent agents in the U.S. Right, and so I mean, we looked at an example just on the last slide with Mark's conduct. I mean, he was not permanently in the U.S. He was coming to the U.S. on a regular basis, let's say, and that's enough to it could be enough to trip over the USTOB issue. So where does the dependent agent context arise is these two pieces here, right? The income tax treaty analysis and as highlighted briefly on the last slide, when you have foreign source income becomes a ECI via a U.S. office, right? So most tax treaties will contain a permanent establishment article, and then within that article, it says that if you have a foreign company that is engaged in U.S. trader business, but it's exempt from tax and it doesn't have ECI because the company doesn't operate from a fixed place of business in the U.S. So what they're saying there is that, okay, you could have a U.S. trader business, but we're not going to make you subject to tax unless you very clearly have a dependent agent or other fixed place of business within the United States. So that's that permanent establishment article. And then just to recap this, the ECI via U.S. office issue for foreign source income. So in this example, let's look at our fake marketing example again. So we have the LLC opens a Tampa office and hires an employee to work full-time as a salesperson. Given the office location, we have the LLC that's engaged in U.S. trader business, and it's got ECI, right? They've got a U.S. office, they've got a U.S. employee. They have a USTOB problem. The salesperson, Jack, makes cold calls to customers. So he makes a call to a customer in Bermuda. They sign a contract. All the work is going to be done by Adam and Sarah in Bermuda. And although that this compensation is arguably going to be foreign source, right? We have people in Bermuda performing the work, the customers in Bermuda, so it's likely foreign source income. Because Jack is in the U.S. and he's operating that U.S. office there, his role in finding the customers might rope in that income as ECI anyway. And this is a common issue with U.S.-based sales offices. It'd be different if maybe Jack wasn't a salesperson. Maybe he's just like a bookkeeper or an accountant, so it's more of a clerical type role. If you can go down that path, then maybe the foreign source income wouldn't be ECI connected with that U.S. office, but in this case it likely is. Okay, so last point here: domestic partnerships must file a 1065 even if there are no taxes owed. This is very, very important, and I have a separate video that covers the reporting on this. I'll put a link to it below. But very, very important here. So let me just touch on this for a little bit. When you have an LLC that's a domestic partnership, again, as I stated on the first slides, it's got to file a 1065 tax return. Now, the 1065 tax return is filed even if there's not going to be any taxes owed. So in the fact pattern that we were working with earlier, where we have Mark, Adam, and Sarah, let's say they're Bermuda company, their LLC, it's a partnership, it has no U.S. trader business, it has no U.S. source ECI. It still needs to file a tax return every year to report the income, report the expense, give a K-1 to each owner, but the reporting stops there. So Mark, Adam, and Sarah won't have to file 1040 NRs. They won't have to pay any income taxes in the U.S. because their entity is not engaged in U.S. trader business and has no U.S. source ECI. But under the reporting rules, a domestic partnership must still file a 1065. And so if you click the link below for that tutorial, I've got a tutorial where I go through Form 1065 reporting for these types of fact patterns. Okay, so that covers it. Thanks for sticking with me to the end here. I know there was a lot of material covered, but I hope it was helpful. And if you have any other questions, please leave me a comment below, and I look forward to seeing you again soon. Thank you.